Hi, good evening, friends. Welcome back to my channel. In today's session, we are going to discuss one of the easiest standard AS1 disclosure of the accounting policies. And from this standard, sometimes we may expect one question, say for 4 marks or 5 marks, and or you may expect one MCQ also. And these are the one of the easiest standard. Even before you didn't study, just listen this class carefully, you will get complete clarity about the standard. Okay, so I will explain all problems in this session along with the concept and the standards like as1, as4, as5, as18. These are very easiest standards, and just watch these videos and that is enough even you didn't study before it. Okay, so then without wasting the time, I will move on to the topic. So coming to the as1, disclosure of the accounting policies. So first of all, what is meant by an accounting policy? What is meant by an accounting policy? And accounting policy simply is a nothing but what, a principle and methods of applying those methods of applying those principles in the preparation and presentation of the financial statements. In the preparation and presentation of the financial statement. This is called as an accounting policy. It consisting of two things, both principles and the methods of applying those, both are covered here. First example for principle consisting of what? So nothing but the rules and the regulations to be followed. For example, inventory is generally valued at cost or NRV, whichever is less. That is an accounting principle. But how to calculate the cost of the inventory? What are the methods we have? Like FIFO method, weighted average price method, and those are covered under the methods. And both principles and methods of applying those principles both are covered under accounting standard. So both are covered under accounting principles, accounting policy. So accounting policy is nothing but principles and methods of applying those in the preparation and presentation of the financial statement. And while recognizing the assets or liabilities or income or expenses, there are number of accounting policies are there. And like for example, in case of inventory, in case of valuation of inventory, we have what, FIFO method and a weighted average price method. In case of cash flow statement, we have direct method and indirect method. In case of valuation of the goodwill, we have average profit method, super profits method, capitalization method, and annuity method. And even in case of method of an accounting, nothing but cash basis is there and accrual basis is there. Cash basis and accrual basis. In that way, if you consider any area of an accounting, we have more than one accounting policy. More than one accounting policy. Then the accountant is having the confusion which accounting policy is required to be followed. Which accounting policy is required to be followed. And those are provided by the corresponding standard. But in this standard, if you select one accounting policy, so what are the rules you have to follow and how to disclose those accounting policies in the financial statement, and that is covered under what, AS1. Okay, and next coming to the selection of the accounting policy, how to select it. And remember, if you select an inappropriate accounting policy, it affect both the income statement as well as what, position statement. Means it is affecting both P&L statement and the balance sheet. For example, if the closing stock is not valued properly, in that case, closing stock is affecting on what, income statement, because it was considered on credit side of the trading account. It is affecting the profit, and as well as it is shown on asset side of the balance sheet. It is affecting the asset side, nothing but position statement, nothing but balance sheet also. So you have to select an appropriate accounting policy. But while selecting the appropriate accounting policy, what are the considerations we have to follow? And there are two considerations are there primarily. And one is the primary consideration, And another one is secondary consideration, primary consideration and secondary consideration. Primary consideration is nothing but financial statement prepared should represent true and fair view only. True and fair view only. So financial statements prepared should represent true and fair view only. What is meant by true and fair view? Nowhere the definition is provided. But when we say the financial statements are representing true and fair view, only if the financial statements are prepared by following Schedule 3 of Companies Act 2013 in case of companies, and if the financial statements prepared by following all accounting standards issued by ICAI and applicable accounting standards, and if the financial statements are prepared by all applicable laws, if any, in force. All applicable laws, if any, in force. If the financial statement prepared by complying with these three, then we said the financial statements are representing true and fair view presentation. If the primary consideration is satisfied, then we follow the secondary consideration. In case of secondary consideration, we have the three factors. And one is nothing but what prudence. So prudence simply is nothing but what conservatism. As per the prudence, only losses can be anticipated. Only losses can be anticipated, and but profits can't be anticipated. Profits can't be anticipated. And prudence says losses while forecasting the future, only losses can be anticipated, profits cannot be anticipated. And based on that, so assets can't be overvalued, and liabilities can't be undervalued. Liabilities can't be under. You can say in another way, assets can be undervalued and liabilities can be overvalued. Based on the prudence only, unrealized profits or stock reserves, if any, those are eliminated and those cannot be shown. So, and at the same time, all provisions like provision for bad debts and provision for bad debts and provision for losses, if any, and those all are created as per this concept only, as per this concept. And you have to select that accounting policy in such a way. So, you by complying with what prudence rule, by complying with what prudence rule. And the best example for prudent, best accounting policy is nothing but inventory is valued at cost or NR, whichever is less, is framed based on this rule only. And another one is substance over the form. What is meant by substance over the form? The reality of the transactions are having priority over legal formality. Over legal formality. The reality of the transaction is having priority over legal formality. Sometimes, for example, I purchase a car in the month of March. In the month of March, and due to some reasons, the registration will be postponed to the May. Postponed to the May. And before 31st March, I didn't get the registration, but I purchased it and I'm using that car for my business purpose. Shall I consider that car in my books of account as an asset? In generally, I didn't have the ownership. So because no registration was completed, so I didn't have the ownership. So as per the rule, I am not the owner. I don't have the right to recognize it as an asset. But as per the substance over the form, it clearly says, are you utilizing the asset for business purpose or not? Yes, I am utilizing it. Will you get the ownership in future? Yes. And in the month of May, so I will get the ownership because the registration will over in the month of May. So you can recognize it as an asset by 31st March in the current year itself. No need to wait the legal formality. Simply based on pending of the legal formality, you can't say this is not your asset. And based on this only, in the asset definition, we have the one word called as what control. Called as what control. Even in case of hire purchase transaction, so hire purchaser will get the ownership initially is getting the possession of the product only, but will get the ownership after completion of the last payment, after completion of the last installment. But as per the accounting, Immediately as and when he received the possession of the good, he is recording the transaction as a asset as per which concept substance over the form. Okay. And another one is materiality. Materiality. As per materiality concept says, only significant items required to be disclosed. Means what? Only material items required to be disclosed. Material items required to be disclosed. What is meant by material item? The disclosure of those items. The disclosure of those items having the impact, having the impact on decision of the users of the financial statement. The disclosure of those items having the impact on decision of the users of the financial statements is treated as a material item. And remember, one item is a material to one entity, but not to the another entity. Whether an item is a material or not, depending upon situation, facts, and circumstances, we have to decide. And you can't say whether the item is a material or not purely depending upon the amount or volume of the transaction. And based on the situation, you have to say. Sometimes, based on the quantity, you have to decide whether it is material or not. Sometimes, based on the quality of the transaction, you have to say. So, for example, there is a change in method of depreciation, and due to that, there is a change in amount of depreciation during the year. Say by the depreciation has been increased by 10,000 due to change in method. But 10,000 is not a material item, that is not a relevant and important item. But change in method, and due to that, there is a impact in profit and loss account because expense side has been increased, profit has been decreased, and there is an impact on asset side because you decrease that amount from the corresponding asset. So it is having the impact on both P&L statement and the balance sheet. So in terms of the quantity, in terms of the amount, it is not a material item. But in terms of the quality of the transaction, it is having the impact on both P&L and the balance sheet. So you have to say that is a material item and require the proper disclosure as per AS1. As per AS1. Only material items or significant items are only required to be disclosed. Means immaterial items are not required to be disclosed. Okay. So these are the 3 points we have so to consider for selecting the accounting policy, one is the prudence, and another one is what substance over the firm, and another one is what materiality. The three items we have. And now, so we select the accounting policy. So how to disclose it? What is the manner of disclosure? Manner of disclosure. And remember, these points are very important from the exam point of view. So, and first, all significant accounting policies required to be disclosed at one place at one place in notes to accounts without scattering throughout the financial statement, without scattering throughout the financial statement. And remember, and this is important, only significant accounting policies required to be disclosed. Only significant accounting policies required to be disclosed. And second one, all significant accounting policies required to be disclosed at one place in the notes to accounts. In the notes to account. In the notes to account, we have what 2 points. One is significant accounting policies. Second one is schedules. Second one is what schedules. Explanation about the items of the financial statement. And all only significant accounting policies required to be disclosed at one place only, and that too in the notes to accounts. Notes to account. And then nothing but what the disclosure of accounting policies or forming part of what financial statement, because those are disclosed in notes to accounts, which is forming part of the financial statement, and without scattering throughout the financial statement. That means what? For example, I have an accounting policy for fixed asset, and after the fixed asset schedule I will record the accounting policy relating to fixed asset. After disclosure of the inventory schedule of inventory, I will record the accounting policy relating to the inventory. After debtors, I will mention the accounting policy relating to the data. This manner of disclosure is said to be a scattering throughout the financial statement, which is not allowed as per AS1. AS1 clearly mentioned all significant accounting policies required to be disclosed at one place only in the notes to accounts. In the notes to account, without scattering throughout the financial statement. And, and the disclosure of accounting policies are forming part of our financial statements, as I said. And one more point is, in case of change in accounting policies, in case of change, sorry, I will discuss the change in accounting policy later. Okay, and so these two are very very important. These two are very very important. Let's see one. Let's see one problem. So here you have to state the comment about these statements. All significant accounting policies adopted in the preparation and presentation of financial statement should forming part of the financial statements. Is it true or false? Yes, that is true. So, because significant accounting policies should be noted at one place only in the notes to accounts, which is forming part of the financial statement. Which is forming part of the financial statement. And the second point, so there is no single list of accounting policy which are applicable to all circumstances. Yes, that is true. Because there are number of areas are there where we have more than one accounting policy. More than one accounting policy. Okay. So this is the one. Okay. So this is about the accounting policies and areas where we have more than one accounting policies and the selection of accounting policy factors to be considered, primary consideration and secondary consideration, and the manner of the disclosure. Manner of the disclosure. And next, one of the important point is fundamental accounting assumptions. What? Fundamental accounting assumptions. Fundamental accounting assumptions are nothing but those those accounting concepts are assumed to be followed in the preparation of presentation of the financial statement. And generally, there are three accounting concepts are there, which are whose following is assumed in the preparation and presentation of the financial statement, and that is nothing but what? Going concern, and another one is, so first going concern, another one is consistency, and another third one is what? Approval. And what is meant by going concern? And going concern says generally the life of the business is infinite. If the entity prepare, if the entity prepares financial statements based on going concern assumption, that means the management is not having management is not having an intention to close its major business operations in foreseeable future. In a foreseeable future. And it means what? If the financial statements are prepared based on the going concern assumption, that means management is not having an intention to close its major line of business operation or its total entire business in the foreseeable future. Foreseeable future stands for what? Nearby future, say 1 or 2 years. Generally, what? Say 1 or 2 years. If the going concern assumption is followed, remember all assets and liabilities are shown at what? Book value only. What? Book value. If the going concern assumption is not followed, and remember assets are shown at NRV and the liabilities are shown at what? Settlement price. Liabilities are shown at what? Settlement price. And second one, consistency. Consistency. So As we discussed, in every area of accounting, we have more than one accounting policy. You accountant is having complete freedom to select any one of the accounting policy. But remember, once you select one accounting policy, you have to follow it consistently from the year after year. So any accounting policy you may select, but the accounting policy selected should be followed consistently from the year after year. Should be followed consistently from the year after year. For example, if I select the FIFO method for valuation of inventory, in the second year also I have to follow FIFO. Third year also I have to follow FIFO. Fourth year also I have to follow FIFO. So, for example, I wanted to change the accounting policy. Am I allowed to change it? So the answer is yes, you can change it. But the change in accounting policy is not allowed in all cases, and change in accounting policy is allowed only if the change is required as per law, or if the change is done as per accounting standards issued by ICI, or for better presentation of financial statements, or for what better presentation of financial statements. And based on these three only you can change. If you want to change the accounting policy, you can change, but only if it is subjected to these cases. If the change is required by law or statute, or if the change is done as per any accounting standard, or for better presentation of the financial statement, you can change the accounting policy. There is no issue. But remember, in case of change in accounting policy, in case of what change in accounting policy, so you have to give the disclosure. You have to give the disclosure. First of all, if it is change in accounting policy is having material impact, is having material impact, or is not having a material impact, not having a material impact. If it is not having a material impact, no disclosure is required. No disclosure is required. If it is having the material impact in the current year or in the subsequent years, in the subsequent year. So, if the change in accounting policy is having the material impact in the current year, then verify whether amount is ascertainable, whether it is quantifiable or not, or amount is not ascertainable, not ascertainable. So means what? How much impact we have on the profits of the current year, and due to the change, how the profits are affected, how the balance sheet is affected, that amount is ascertainable or not. If the amount is ascertainable, amount should be disclosed. Amount should be disclosed. If the amount is not ascertainable, remember, fact should be disclosed. Fact should be disclosed in the notes to accounts. Even the amount is unable to ascertain it, fact should be disclosed. But if the material impact, if the change in accounting policy is having the material impact in the subsequent year, not in the current year, there is a change in current year, but material impact is having in subsequent period. In that case, in the current year, fact should be disclosed. Fact should be disclosed regarding the change. In the subsequent year, amount should be disclosed. Amount should be disclosed. And it means what? We have to disclose why the changes happen, and what is the nature of the change, and how much amount of the profits are affected. In case if the amount is not ascertainable, then what fact should be disclosed. These are the 3 points you have to remember in case of change in accounting policy. And first remember, in case of account, can we change the accounting policy? Yes, under three cases. If the change is required by law or accounting standards, or for better presentation of the financial statement. In case of change in accounting policy is having the material impact in the current year or in subsequent year, then only we require to disclose it. If it is not having the material impact, ignore it. Don't disclose that. If it is having the material impact in current year and the amount is ascertainable, then amount should be disclosed. If it is having the material impact in current year but amount is not ascertainable, then fact should be disclosed. If it is having the material impact in subsequent year, then in the current year, fact should be disclosed, and in subsequent year, amount should be disclosed. This is about what? Second fundamental accounting assumption, nothing but what? Consistency. And what is the third one? Third one is nothing but accrual. Accrual. And it means what? The transactions are recorded as and when they are incurred, irrespective of payment or receipt of the cash. Irrespective of the payment or receipt of the cash. Accrual concept always followed. So to comply with the matching concept, to match the income with the corresponding expense or expense with the corresponding income, we have to record based on the incurrence of the transaction, and based on this only, expense is equal to what? Paid plus payable minus what? Paid in advance. Paid in advance. This payable paid in advance accounts are created as per the accrual concept only. In the same way, income also defined as what? Received plus receivable minus received in advance. Received in advance. And one more point is, as per section 128 of Companies Act 2013, books of accounts of company. In case of company, books of accounts should be maintained under accrual basis only. There is a mandatory thing on in case of company as per section 128 of Companies Act 2013. But in case of sole trader or in case of partnership firm, there is no such type of compulsion over there for maintenance of the books of account. But company should follow the accrual basis. For example, if the company select the cash basis of an accounting, it is violation about what? Section 128 as well as a fundamental accounting assumption. Okay. And next, for example, if the company is preparing financial statement by following fundamental accounting assumption, then no need to disclose. But if the company is preparing financial statement by not following fundamental accounting assumption, then we have to give the disclosure in notes to accounts. And regarding what? Fact and amount, sorry, fact and amount affected because of that not following the fundamental account. Fact should be disclosed mandatory. So if the financial statement prepared without by financial statement prepared without disclosing the fundamental accounting assumption, means that financial statements are prepared by following that corresponding fundamental accounting assumption. Those disclosure is required only if financial statements prepared without following fundamental accounting assumption. Okay. So this is simply is a nothing but what? AS1. Okay. In AS1 we completed what? So here, so what is meant by an accounting policy? Areas where we have more than an accounting policy. In case of change in accounting policy, what we do? And relating to the disclosure. And what are the factors? Primary consideration, secondary consideration. In secondary, consider substance over the form, materiality, and prudence. And another one, what are the manners of disclosure? All significant accounting policies are selected in the preparation presentation of financial statements should be disclosed, and all significant accounting policies should be disclosed at one place and without scattering throughout the financial statement. Disclosure of accounting policy is forming part of the financial statement, nothing but notes to account. And then we discuss fundamental accounting assumption, nothing but going concern, consistency, and approval. And its disclosure is required only if the fundamental accounting assumptions are not followed in the preparation and presentation of the financial statement. Okay, this is AS1. Very, very simple standard and easy standard. Okay, and I will upload this material. So in the Telegram channel, and very important content I will upload there. And so join the Telegram channel and you can download it there. Okay. Next, coming to the questions. So in the books of Messrs. Prashant Limited, closing inventory as at 31st March 2000 XT amounts to 1,63,000 on the FIFO basis. and the company decides to change from FIFO to weighted average for ascertaining cost of inventory from X1 to X2 on the basis of weighted average method. Closing stock is valued at 1,47,000. Realizable value is 1,95,000. Actually, if you follow the FIFO, it should be 1,63,000. If you follow the weighted average price method, it was 1,47,000. And there is a decrease in, so generally as per ES inventory is valued at what? Cost or NRV, whichever is less. So 1,47,000 or 1,95,000, whichever is less, 1,47,000 only. If you follow the FIFO method, what is the value? 1,63,000. There is a decrease in value of the inventory. So due to the decrease in value of inventory, there is a decrease in profits also. How much profits are decreased? So 1,63,000 minus 1,47,000. Nothing but 16,000 profits are decreased. 16,000. So how to disclose it as per AS1? So here is the disclosure. The company value its inventory at lower of cost or NRV, and since NRV of all items of inventory in current year was greater than respect to cost, company valued it its cost. In the present year, company has changed it to weighted average price method, which better reflect the consumption pattern of inventory. This is the reason. And for ascertaining the inventory cost from the earlier practice of using FIFO method for the purpose. Due to the change in policy reduce the current year profit. This is the amount. You ascertain the amount. So what is the impact of change in method? It is having the impact in P&L as well as in balance sheet. So both has to be disclosed. How much profit is affected? How much amount of assets or liability has been affected? Okay. Next. Second question. So then we'll move on to the another one. Second question we'll cover in another question also. Okay. Third one. XYZ company is engaged in the business of financial services and is undergoing tight liquidity position. Since the most of the assets of the company are blocked in various claims or petition in special court, XYZ accepted intercorporate deposits and it is making its best efforts to settle the dues. There were claims at various varied rates of interest from the lenders and from the due date of ICDS. So to the date of payment, the company has provided interest as per the terms of the contract till the due date. And a note for non-provision a note for what? Non-provision of interest on the due date to the date of repayment was affected in the financial statement on account of uncertainty exists regarding the determination of amount in the absence of any specific legal obligation at present as per the terms of the contract. The company consider these claims are in the nature of claims against the company not acknowledged as a debt. So means what they are showing it as a contingent liability. And the same has been disclosed by way of notes to accounts instead of making the provision in statement of profit and loss. State whether treatment done by the company is correct or not. Here, company is not paying the interest. Company is not paying the interest due to its poor liquidity position. So, but the another lender is not waiving of the interest. For example, if the lender waive of the interest, then no need to create any provision. But as per accrual concept, you have to create what? Provision. You have to create what? Provision. So because transactions should be recorded as and when they are incurred. So here, as per accrual concept, one of the fundamental accounting assumptions, irrespective of the terms of contract, so long as principal amount of loan is not repaid, the lender cannot replace disadvantageous position of non-payment of interest in respect of overdue amount. So it apparent that company has an obligation on account of overdue. So as we have the obligation, we have to create what? Provision. So non-provisioning of overdue interest liability amounts to violation of accrual basis of an accounting. So therefore, treatment done by the company of not providing the interest amount from the due date to the date of payment is not correct. Okay. And give the examples of areas where accounting policy adopted could be different for different enterprises. And would there be any adverse impact due to the adoption of different accounting policy? And if yes, how does the accounting standard one seeks to address such issue? So there are different industries. Generally, some industries are following the FIFO method for valuation of inventory. Some inventories are following what? Weighted average price method. Weighted average price method. So, so depending upon the position and depending upon the situation, they may select any one of the accounting policy and completely they are having the free hand. But AS1 says only one thing. You are having the free hand to select any one of the accounting policy, but once you select, you need to follow it consistently from the year of the year. Okay, so clearly mentioned, while an entity is free to choose its accounting policy as long as in the financial statement reflect true and fair. This is the primary consideration we have. So, state of affairs of the enterprise, asset balance sheet date, and of the profit and loss for the period ended. Application of different accounting policy by different entities affect only one feature of the financial statement, nothing but comparability of the financial statement of such different entities by stakeholder and analyst investor. To mitigate the loss comparability, AS1, disclosure of accounting policy required, disclosure of significant accounting policies as a part of the financial statement. This would help the users of financial statement to understand which policy they followed. Okay, based on that, they will do the analysis. Okay, and so this is important question. You have to state the comment with reason. Certain fundamental accounting assumptions underlying in the preparation and presentation of financial statement. They are usually specifically stated because their acceptance and use are not assumed. And remember, this is the false because the acceptance and use of the fundamental accounting assumptions are assumed. So, if the fundamental accounting assumptions are required to be disclosed only if those are not followed in the preparation and presentation of the financial statement. Okay. B. If the fundamental accounting assumptions are not followed in the financial statement, a specific disclosure is not required. This is also false. If it is not followed, then it is required. Sorry, it is required. Okay. And third one, all significant accounting policies should be forming part of the financial statement. Yes. Any change in accounting policy which is having the material impact should be disclosed. Yes. Only material impact, change in accounting policy having the material impact should be disclosed. And where the amount by which item in the financial statement affected by such change is not ascertainable, wholly or part, the fact need not be disclosed, need not be indicated. Yes. If the amount is ascertainable, then amount should be disclosed. If the amount is not ascertainable, then fact should be disclosed. So where the amount by which any item in financial statement affected by such change, sorry, if the amount is not ascertainable, then fact should be disclosed. So this is also what false. Fact should be disclosed. There is no single list of accounting policy already we discussed. Okay. So this is the one important one. ABC Limited was previously making the provisions of non-moving stock based on the stock not issued for the last 12 months up to the 31st March. Now the company wants to make the provision based on technical evaluation during the year ending 31st March. And the total value of stock 133.75 lakhs. Provision required based on technical evaluation 4 lakh. And provision required based on 12 months not issued 5 lakh. So here previously we followed provision based on 12 months not issued, and at present we wanted to follow provision required based on technical evaluation, and here how to disclose these requirements in AS1. So you have to mention the fact, and remember, if there is a change in the respected provision, remember change in provision is not a change in accounting policy, it is a change in accounting estimation. But if the change in accounting estimation is having the material impact, it should be disclosed to the extent of how much amount is affected in the profit and loss or balance sheet. But here there is a change in creating the provision method. So previously we followed non-moving stock basis, and now we follow technical evaluation method. Due to that, there is a decrease in 1 lakh of value of the inventory. Due to that, there is a decrease in profit by 1 lakh in the current year and compared with the previous year. So here is the disclosure. The company has to provide for non-moving of inventory on the basis of technical evaluation, unlike the preceding years. Had the same method been followed, means if the whatever the method you followed in the previous year, if the same method we followed, then current year profits are increased by 1 lakh. Correct? Current year profits are increased by 1 lakh. Then the profits for the year and corresponding effect on the year net assets would have been lower by, well, the current lower by 1 lakh means it has been increased in the current year. For example, the non-moving stock we followed, profits for the inventory provision, sorry. If the non-moving stock we followed, we have to create the provision of how much amount? 5 lakhs. How much amount? 5 lakh, right? How much amount? 5 lakh. There is an increase in provision by 1 lakh. And there is a decrease in value of stock by 1 lakh. Then due to that, current year profits are decreased by 1 lakh and the net assets are also decreased by 1 lakh. Okay, sorry, correct. And second one, in the books of K Limited, closing stock as on 31st March amounts to 1,24,000 on the basis of FIFO. And the company decides to change FIFO to weighted average and ascertainable cost of inventory from the year 2020 to 21. On the basis of weighted average price method, closing stock valued at 1,15,000, realizable value 1,54. As we said, as per AS2, inventory is valued at cost or NAR, whichever is less. So 1,15,000 is the value. But due to the change in method, previously we followed FIFO. Then due to the value of the stock 1,24,000, if you follow the weighted average, 1,15,000 is there and there is a decrease in value of the stock. How much amount? 1,24,000 minus 1,15,000, 9,000. And due to that, inventory has been decreased by 9,000 and it is having the impact on profits and net assets are also decreased by 9,000. And that amount required to be disclosed. The company values its inventory at lower of cost and NRV, and since NRV of all items in the current year was greater than respect to cost, company valued at cost. The current year, company changed it to weighted average price method, unlike the previous year, and due to that, so amount of the profit has been affected by amount of the inventory affected by amount of the inventory, amount of the profit, both are reduced by how much amount? 9,000. Okay, and this was already we discussed now. Jeevandeep Limited had a right issue in 2020. In the offer document to its member, it has a projected surplus of 40 crore during the accounting year to be ended on 31st March 2022. The draft results for the year prepared on the hitherto followed accounting policies and presented for perusal of the board of directors showed a deficit of 10 crore. The board, in consultation with the managing director, decided value year-ended inventory works cost 50 crore instead of either to method of valuation of inventory at prime cost 30. Previously, that party is having the policy to follow the value the inventory at prime cost, but now they shifted to they shifted to value the inventory at works cost. Due to that, there is an increase in inventory. There is an increase in value of inventory by how much amount? 20 crore. Okay, next. Provide the depreciation for the year on straight line basis on account of substantial additions in the gross block during the year instead of reducing balance method, which had hitherto adopted. As a consequence, charge of depreciation of 27 crore is lower than the amount of 45 crore, which would have been provided had the old method has been followed by 18 crore. Actually, there is a change in method of depreciation is not a change in accounting policy. It is a change in accounting estimation. But even the change is having the material impact because due to that there is a change in profit and change in value of the asset. So it is having the material impact. So we have to give the disclosure in notes to accounts. So here that is the first point. So how much profits have been increased? 20 crore. Coming to second point. So this is not a change in accounting policy, but due to the change, there is a increase in profit was increased by how much amount? 18 crore because amount of depreciation has been decreased. And next, not to provide for after sale expenses during the warranty period. Till the last year, provisions 2% on sales used to be made under the concept of matching of cost against the revenue. And actual expenses used to be charged against a provision. And board now decided to account for expenses as and when actually incurred. Sales during the year total to 600 crore. And previously, we are having the policy to provide provision for after sale provision for losses relating to after sale expenses. But now the company decided those want to provide on accrual basis of an accounting. And due to that, current year there is no provision was created. How much provision? 2%. Nothing but 600 into 2%. Nothing but what? 12. So 12 crore. So due to the non-provisioning of the after sale expenses, there is an increase in profit by how much amount? 12 crore. Okay. Next. Provide a permanent fall in value of investment. This is relating to what AS 13 also. So in case of AS 13, permanent reduction in the value of non-current investment should be considered. Temporary investment cannot be considered. Which fall had taken place over the past 5 years, the provision being 10. So management decided to provide its notes in notes to accounts. So permanent decrease in value of the investment should be considered. Due to that, provision has been created for diminishing in the value of investment. Due to the profit is decreased by, because we create the provision, the profits are decreased by 10 crore. Okay. So here the profits are increased by 20 crore. Here the profits are increased by 18 crore because there is a decrease in depreciation. And here profits are increased by 12 crore because non-provisioning is created. But here the profits are decreased by 10 crore. Okay. These are the impacts. Okay. Next, ninth one. Lion Limited engaged in manufacturing and construction contracts and prepared its financial statement for the year ended 31st March. And company follow historical cost for fixed assets, FIFO for inventory, and percentage of completion method for revenue recognition in construction contract. During the year, management changes. Inventory valuation method from FIFO to weighted average due to the volatility in raw material prices. This is what change in accounting policy, and due to depreciation method from straight line to WDV. So sitting better reflecting the assets usage. This is change in accounting estimation, not the change in accounting policy. Company disclose the change in inventory method in notes, but does not disclose the change in depreciation method. So stating that it is not material. And remember, material means what? Not only the quantitative, you have to verify in qualitative also. In terms of the quantity, means in terms of the amount affected, it is not a material item, but in terms of the impact we have in the profit and loss as well as in the balance sheet, it may be the material. So simply based on the amount, you can't say it is not a material. Okay. Additionally, the change has not been disclosed in accounting policy and recognition of government grant, and this is also violation about what AS 12, though it has been received significant subsidy, significant amount of subsidy. You are required. So identify and explain violations of AS1. Violations of what AS1. And two violations we have. Two violations we have. In case of change in accounting policy, we have to give the disclosure. Change in accounting policy, we have to give the disclosure. This was provided. But remember, second point, change in depreciation method. As per AS10, change in method of depreciation is not an accounting policy, but it is an accounting estimation. It is so AS1 also clearly stated any disclosure of material item should be disclosed, should be provided in notes to account. But here, the change in method of depreciation is not having such material impact in the current year in terms of the amount. But remember, it is having the impact in profit and loss account and the balance sheet. Based on that, you can say it is a so qualitative material impact. So depreciation affects key financial figures such as profit, asset value, and return ratio. Even if the change is classified as an estimate, if it is having a material impact, disclosure is warranted. Company decision is not to disclose change in on the ground that immateriality may not be appropriate unless supported by clear quantitative evidence. And non-disclosure of accounting policy. It is violation about AS 13 also. And Lion Limited has received a significant subsidy during the year but has not disclosed in accounting policy for government grant. As per AS1, all significant accounting policies should be disclosed, including those for government grant. Hence, non-disclosure is violation about what AS1. Okay. And one more second question is, and critically evaluated whether materiality can be used as a justification for non-disclosure of change in accounting policy. That's what we discussed previously. So I told you, in case of change in method of depreciation affects not only the profit and loss but also the assets value and tax liability. And thus, even if quantitative impact appears small, its qualitative impact may be the significant. So simply based on the quantitative impact, you can't say it is not material. So always you also required to be consider whether it is having an impact on what? Profit and loss, balance sheet, ratios, all are affected. So that's why qualitative impact we have due to the change in method of depreciation, even if it is involving small amount. Therefore, company reliance on materiality as a justification for non-disclosure is not a valid unless there is a concrete evidence showing the impact is indeed immaterial, both quantitatively and qualitatively. Okay, and how to disclose it? In change in method of change in accounting policy is having the material impact in current year and amount is ascertainable. It should be disclosed. We have to disclose the amount. Otherwise, fact should be disclosed. What is required to be disclosed? Why the changes happen and its nature and impact on financial statement. These three. If the impact on financial statement unable to ascertain, fact should be disclosed. And this is theory question we have. And 10th one, A Limited has sold its building for 50 lakh and purchaser has paid full price. And the company has given possession to the purchaser. And the book value of the building 35 lakh. As on 31st March 2007, documentation legal formalities are pending. And the company has not recorded sale. But as per substance over the form, what so reality of the transaction is having the priority over legal formality. So already we sold the asset and that party is using the asset. Only legal formalities are pending. Based on that, you can't say the sale is not happened. So in the current year, by 31st March, we can recognize the sale transaction and the gain or loss will be transferred to profit and loss account only as per only one concept called as substance over the form. Okay. So here A Limited should recognize sale and recognize the profit of 15 lakh and P&L. Should be eliminate building from its balance sheet. In notes to account, it should be disclosed the building has been sold. Full consideration has been received. Possession has been handed over to buyer. Documentation and legal formalities are pending. This is done as per substance over the form. Buyer should recognize the building as an asset in his balance sheet and charge the depreciation on it. Buyer should disclose in notes to accounts and the that possession has been received. However, documentation or legal formalities are pending. Okay, next. And interest related point already we discussed. And this is the one. A Limited had made it. So, sorry, this was also we discussed. And this is completely about what AS1 disclosure of accounting policy. I hope you enjoy the standard. So, I will upload this material in my telegram channel and please follow the join the telegram channel and you can download it from the telegram channel. So and one more thing is, if you like the video, if you enjoy the video, please don't forget to press the like button. And also, if you are new to my channel, please subscribe it and also share it to your friends. And I will come up with a new standard. Okay, thank you, take care, bye bye bye.